Hey, we had a big day today. Today was a crazy day in the stock market. We had a very big reporting on inflation today. And as you might have seen, market ripped today. So the S&P 500, it was up 2.13%, closing at 4,210. So it's above 4,200 right now. We got the NASDAQ 100 coming in at 2.85%, closing at 13,872. And we got the Dow Jones Industrial Average over 33,000, closing at 33,309, up 1.63%. So I think we could say that today was a big day in the market. Obviously, it was up quite a bit, and there's a lot to uncover because CPI came out, and because CPI came out, now we have this new data, and now we need to figure out if this data is going to change our mind about what's going on in the economy and what's going on with inflation and the interest rates that the Federal Reserve has to set, right? So we got to talk about all these things. All right, but the first thing that I want to go over is a meme. So this is from Dr. Parik Patel, aka Dr. PP. This guy runs a meme account, but it's an amazing meme account on Twitter. This is investors interpreting the CPI report. Prices increased 8.5% year over year in July, and you're like, wait a sec, that's not good. Like 8.5%, that's a lot of inflation. Like, I don't like that. Prices are increasing at a lower rate. Oh, okay. Now you got me thinking. Maybe prices are going down, right? So this is kind of what we're dealing with here. Yeah, 8.5% inflation, terrible, not good. We don't like that year over year. So this time last year, we're up 8.5% in inflation. However, from last month, coming down. And from last year, coming down as well, because last month, it was about 9.1% was the inflation year over year number. Now 8.5%. Hey, if you just draw a linear line, if you extrapolate that down, we're looking pretty good in a few months. So we're trying to figure out where we are right now. Now let's go to this next part, which is what does the Federal Reserve do? Why does this matter? And really the reason is because there's a dual mandate with the Federal Reserve. So the Federal Reserve, it has a dual mandate. It has to do two things. So one of those two things is there needs to be price stability. So we need to make sure that prices don't increase too much. We don't want too much inflation. Hyperinflation is a terrible thing, and we don't want too much inflation in our economy. And also, we want maximum employment, or at least we want low unemployment, right? There are different ways to say this. We want to have people at work, and we don't want prices to be rising too much. Those are the two things they do. And right now, we're looking at price stability, and price stability is kind of high. But what we're thinking is maybe the Federal Reserve, if they're thinking that maybe price stability is getting closer to what it wants to be, as in it's going down now, inflation is starting to go down a bit, maybe we hit peak inflation, maybe the Federal Reserve does not have to hike interest rates as much going forward. That's the big thing, because interest rates can be like gravity for the stock market for stocks. It has many effects for the bond market, right? If you have to take a loan out, if you need to buy a house, if you have credit card bills, whatever it is, loans have interest and you have to pay interest, and it has huge effects and ramifications on the economy, not to mention a lot of different things. So then there's maximum employment, and if you hike interest rates too much, if you're the Federal Reserve and suddenly you hike interest rates 5%, you could literally kill businesses all over the place and suddenly people will lose their jobs. So there's this balancing act that it's doing right now, and it's a scale, right? And it's trying to figure out the best way to do this. Let's first focus on the employment part of that scale that we were looking at before, and then we're going to talk about inflation and CPI and what came out today. So, okay, this is Macro Alf, and he says the job market has now recovered all jobs lost during the pandemic. That is a great headline. All the jobs that were lost during the pandemic have now been recovered. So essentially, things were not good for a while back in 2020. A lot of people were hurting. And right now, employment-wise, people are doing a lot better. Today's report is definitely enough to kill any chatters on a Fed pivot, but there were many other nuances worth discussing. In a nutshell, short-term inflationary, long-term bad for growth. Then he has this thread. So what Macro Alf was saying is that this is a few days ago, but he's basically saying that employment is actually looking strong in terms of how many jobs there are, but let's kind of go a little bit deeper. The job report that came out on August 6th, it showed 500,000 new jobs. So much more than what's really necessary to keep things, let's say, stable given demographics in the U.S. That is a great thing. Alf goes on to say, he shows some other things about the household survey data. Now, this is like basically surveys that are taken, and they call up people and they ask what's going on. And it takes into account all businesses, so including the ones which failed to report in the established BLS survey. It's not getting the nitty gritty here. Basically, it's a survey, and it's saying that it came out weaker. This part of the survey came out weaker. And what it's saying is full-time workers are actually down. So maybe that's not that great. Full-time workers are down. Part-time workers are up. So if you look over here, you can see full-time workers, well, 132, and this is in thousands. So let's say 132 million people working full-time in June 2022, but July 2022, it actually was down a bit. So we actually lost in full-time. And you want jobs that are full-time jobs more than part-time jobs, right? You want people to be fully employed. So that maybe not be the best thing that we're seeing here. So maybe employment is good, lots of new jobs, but maybe the jobs that people have are not that great. So, okay, that's that part. So let's say the job market is looking decent. Like everything's pretty good there. And that's a part of that scale, right? Now they have the other part. We have CPI, or the Consumer Price Index, inflation. July CPI inflation eased 8.5% year over year. So inflation went up 8.5% year over year. People thought they were estimating it to be 8.7, so it came in better than they thought. 9.1% in the prior month, okay? Last month's year over year inflation was 9.1%. Now it's 8.5. That's better over a 1 month period. The core inflation, let's say it strips out certain things like energy, like food, okay? So core inflation was 5.9% versus 6.1 estimated. That's great. And we have 5.9% for the prior month. And then if we just go down here, we can see the chart of what's going on with CPI. This is urban consumers year over year in blue. Then we have CPI urban consumers without food and energy. Okay, so that's going to be core inflation in the orange. So here we have 8.5, 5.9. There you go. Things are better than they thought it would be. However, remember that meme that we were talking about earlier, 8.5% inflation is still terrible, right? That's not what we want to see. And this is going back into the 70s when inflation was really bad, really rampant. And look at this, like look how high it was back then. We don't want to be anywhere near there. That's why we're saying, okay, if we're hitting peak inflation now, that's great. Maybe it starts coming down, the economy starts getting better. Not that it's that bad, honestly, as we saw from unemployment. So this is what we now are expecting. So there are expectations now. This is why the market was doing well. Because the market was expecting something, and now it's expecting something different in terms of interest rates. So the Fed rate hike expectations after the report, that was today, September, 50 basis point hike to 2.75% to 3%. So that's what the market thinks is going to happen with the Fed. The Fed is going to hike interest rates between 2.75 to 3% in September, and then November, and then December. And this is now down. So these numbers are lower than what people were expecting, right? And so that makes the stock market go up because the stock market is based on interest rates. Well, the very important part of the market, right? So high interest rates are bad for growth. Low interest rates are better for growth, right? So if we have lower interest rates in the next few months, market goes up because we're going to potentially make a lot more money. Some other good news here. Okay, gas prices, all right? Gas prices across the U.S. are now at $4.01 per gallon for the national average, down a whole dollar. This is below their all-time high that was hit in mid-June, so that's great. These are the different areas. So if you live in one of these areas that are in blue or white, you're doing pretty decent. If you're in the red areas, you got pretty high gas prices still. Some places up to $5.41. That's really high, of course, and that's really hurting the pockets of consumers. Over here, we can see how that can actually be affecting people. So U.S. wages increased 5.2% over the last year, while CPI rose 9.1%. This was before the CPI print today. So basically, what we're saying here is that the amount of wages that have increased over time have not outpaced inflation. So people are losing money to inflation. If I make 5.2% more in my salary, but all the goods and services around me go up 9.1%, that's bad. I'm still not keeping up, right? And so we can see what's happening here. When we look at the U.S. personal savings rate, it's declining. And that's not something we love to see because we want people to also be able to get ahead in this world, right? You want them to not go and have to live on credit. And over here we have credit. So this is U.S. personal savings rate down to 5.1%. Look how high it got when stimulus checks were coming out and pandemic was hitting. And then it went down, of course. And now we're pretty low, right? We're back to like the 2009 area. Now, over here, though, we have U.S. consumer credit year-over-year change. So this is the change in how much credit people are using, right? So if I go out and I get a credit card and I put money on a credit card, is it going up or is it not going up? Well, it's going up a lot, 7.7%. And this is, again, close to back, like 10 plus years ago, back to 2011, when 8.5% was the peak increase in consumer credit. So we don't like to see people spending too much money on credit, because then it gets to this point where they can't pay off the credit cards if their personal wealth is deteriorating to inflation, right? So this isn't good. And another really important thing I do want to touch on is what's going on with, let's say, rent. And so in terms of that, it's getting really high. And this is actually, it's sticky. The thing about this with CPI, with inflation, it's a very sticky number. If your rent goes up, it's probably not going to go down for a year, right? Let's say every year you renew your contract 1 year, your rent goes up. Well, for the next 12 months, it's going to stick there, right? And it's likely not going to go down, because that's not usually what happens unless we're in a bad recession or something like that. So owner's equivalent rent portion of the CPI was up 5.8% year over year. That's the fastest gain since September 1990. So when we're talking about where people are going to live, renters, it's going up at a high rate, and that's not good. So here we're looking at what's going on in the real estate market. So we know that if you take a loan out and you have an interest rate, and that interest rate gets higher because the Fed starts rising rates, well, now you're going to have to pay more money to have the same amount of house, right? So it should, in theory, make the prices of houses go down, right? Because I'm going to pay more money in my interest rate for the loan I'm going to take out, unless I pay in cash. So, okay, this is what's going on here. Over a 4-week rolling average period, so let's say a month, how many homes had price drops during that, let's say, month? And they do it on rolling 1 month periods going back. So 7.7% of homes dropped the price of the home right now that's on the market. So that is the highest since they started tracking this, meaning that really housing is maybe starting to finally come down a bit. Maybe it's going to get a bit more affordable for some people, hopefully. So that could be a good thing, but also in terms of real estate, if all of your wealth's in your house, it could be bad because it could feel like you're maybe losing some money, but if you're not selling your house, then you might not care. We've had some negatives. We've had some positives. Where are we right now? It's all kind of a big gray area, right? So let's kind of end this part of the video with this from Ben Carlson. The average annual return for the S&P 500 since 1928. When inflation is rising, the average amount that people have earned in the stock market in the S&P 500 has been 6.7%. That's a good return, right? That's okay. Not too bad. Then, when inflation is falling, it's actually a much better time to invest. 16.5% has been the average return over that time period. Of course, this is a long time period with a lot of different outcomes that were happening, and we're probably in a bit of a different situation than a lot of those different things. However, just one of those optimistic things that we could throw in here towards the end. So maybe during a time period when interest rates are going down, this could be a good time to invest. Last thing I want to do is talk quickly about what's going on in the charts for the S&P 500. That's what we're looking at here. This is the SPX. So basically, of course, I didn't do anything crazy here. We're in a downtrend channel, potential downtrend line here as well. Let's zoom in here and let's see what's going on. So the main thing I'm watching is we got this downtrend line, and we have this candle that gapped up because of what happened with the CPI today. Now it's sitting on the top of this downtrend line. So what's going to happen? I'm not sure, of course. I don't know. I don't have a crystal ball. However, I like that it's up here, and I love that things are looking better, and let's say sentiment's looking pretty good. However, what I don't like is that RSI, which is an indicator, right, the relative strength index, is high. And I don't like how high it is. And I also don't like how high MACD is. So MACD down here is very high, RSI is very high. And so let's take a look at MACD and RSI, and let's see what's happening during the market when these things are up. So we're looking at a pretty high MACD here. Well, it was not a good time to be in the market, right? From there, we had a big drop. Over here, we had the same April 1st of 2022. We had very high MACD, big fall down. And so right now our MACD is really high in the market, and RSI is very high in the market. That doesn't make me feel well about and like what's going on right now in the S&P, just in the short term, not in the long term. So I do think that there's potential pullback. I don't know if this is going to actually stay above this downtrend line. I feel like it's going to come back down into the channel. And I don't know, maybe later it will bust out of that thing and maybe it will reject the resistance area. Not reject, but maybe it will break up through the resistance area. So let's see what happens. If it does, I mean, we could be looking at a good end of the year. So the sentiment might be turning around here. I'm not sure, but I do think things have changed a bit because of the CPI print. We're going to have to wait till late next month to see what happens on next month's CPI. So that's all I have for today. Things are interesting. Hope you enjoyed the video. If you did, please subscribe and hit the like button and watch another one of my videos coming up on the end screen right now.